The S&P 500 has had three of its worst weeks in the past 2 years. Oil prices have whipsawed in ways that would have seemed impossible 12 months ago. Treasury yields are doing things that keep bond traders awake at night. And gold. Gold is doing what gold always does when the world gets nervous. It's climbing. Here's the backdrop. Tensions between Iran and Israel have not cooled. They've escalated. Iranian proxy networks across Iraq, Syria, and Yemen have become more aggressive. The Strait of Hormuz, that narrow, absolutely critical choke point through which roughly 20% of the world's oil flows, has been threatened, interdicted, and partially disrupted multiple times in the past 18 months. At the same time, the war in Eastern Europe is entering a more dangerous phase. NATO's commitment is being tested. Energy infrastructure in Central Europe is under pressure. And China is watching Taiwan with the kind of quiet, patient attention that makes defense analysts nervous. Three separate theaters. Three separate escalation timelines. All converging on one thing: uncertainty. And here's what you need to understand about financial markets. Uncertainty is not just an emotion. Uncertainty is a pricing mechanism. When investors cannot calculate the future with even basic confidence, they don't sit still. They move money. They hedge. They sell what feels fragile and buy what feels permanent. And that movement, that massive, often panicked redistribution of capital, creates opportunity. But only if you know where to look. Let's walk through exactly what happens to financial markets when geopolitical conflict escalates. Step 1 is the shock. A missile strike, a naval incident, a sanctions announcement that the market didn't fully price in. The initial reaction is always the same. Equities fall, the volatility index, the VIX, spikes, and capital rushes toward safe haven assets, US Treasuries, the dollar, gold, Swiss francs. This is the panic phase. It usually lasts anywhere from 3 days to 3 weeks depending on how severe the event is. Most retail investors experience this phase and make their worst decisions right here, right in the middle of the chaos. Step 2 is the recalibration. Markets start to assess whether the conflict is contained or expanding. Analysts revise earnings forecasts. Energy companies start pricing in supply disruptions. Defense contractors see order books fill up. Shipping companies adjust routes and rates. Insurance premiums on cargo vessels in conflict zones triple overnight. This is where the informed money starts moving. Not chasing, not fleeing. Repositioning. Step 3 is the adaptation. Here's the thing about markets that most people forget. They are ruthlessly adaptive. Within weeks of any major geopolitical event, capital has already found new routes, new narratives, new winners and losers. The panic subsides, and the investors who position themselves during Step 1 and 2 are now sitting on gains while the late arrivals are just now figuring out what happened. The cruel irony of geopolitical investing is this: by the time it feels safe to invest in the theme, most of the money has already been made. Now here's where it gets interesting. Most investors look at a war and think, this is bad for markets, full stop. And in the short term, they're right. Conflict creates risk. Risk creates selling pressure. Portfolios take hits. But zoom out even slightly, and the picture changes completely. Let's look at oil first, because it's the most direct transmission mechanism between Middle East conflict and American financial markets. When the Strait of Hormuz faces disruption, even the credible threat of disruption, oil prices spike. We've seen this pattern repeat itself going back decades. In the first Gulf War, crude jumped over 50% in less than 4 months. After the Houthi attacks on Saudi Aramco facilities in 2019, oil spiked 14% in a single day, the largest one-day move in decades. Now fast forward to today. U.S. shale producers, the companies in Texas and North Dakota and Pennsylvania sitting on top of enormous reserves, become dramatically more profitable every time Middle East supply is threatened. Their production costs stay roughly the same. Their selling price goes up. That's margin expansion without doing anything differently. ExxonMobil, Chevron, Pioneer Natural Resources, ConocoPhillips. These aren't exciting tech companies. They don't have viral product launches. But when geopolitical tension spikes oil, they print money. Here's the number that stopped me cold when I first really looked at it. During the period from 2020 to 2022, which included a global pandemic, the early stages of the Ukraine war, and persistent Middle East instability, the energy sector of the S&P 500 returned over 200%. The tech sector, which everyone was obsessed with, returned roughly 60% in the same period before giving most of it back. Nobody was talking about oil stocks in 2020. Everyone thought clean energy had permanently killed the fossil fuel trade. They were wrong. Now let's go somewhere slightly more uncomfortable, because energy is just part of the story. And the smarter money, the money that has been consistently profitable across every geopolitical crisis of the past 30 years, has always known about the other trade: defense. The United States defense budget for fiscal year 2026 is approaching $900 billion. That number has increased every single year for the past decade, and when conflicts multiply globally, congressional appetite for cutting that number evaporates completely. Raytheon Technologies, now RTX, General Dynamics, Northrop Grumman, L3Harris. These companies don't just benefit from American military spending. They benefit from allied nations rearming in response to perceived threats. Germany has committed to spending 2% of GDP on defense, a historic shift for a country that spent decades actively minimizing its military footprint. Poland is now spending 4%. Japan revised its pacifist constitution and is buying missiles. Every one of those purchases flows through American and allied defense contractors. The uncomfortable math is this: the defense sector of the S&P 500 has outperformed the broad market in every major conflict escalation of the past 40 years. Every single one. Vietnam, the Cold War buildup under Reagan, the Gulf War, the post-9/11 decade, Ukraine. And the reason most retail investors miss this trade every single time: it feels wrong to profit from conflict. It feels predatory. But here's the reality check. Whether you invest in defense stocks or not, those contracts get signed. Those weapons get built. That money flows somewhere. The question is simply whether it flows to you or not. I'm not telling you what to do. I'm telling you how the mechanism works. Let's shift gears, because there's a third dimension to this story that gets almost no coverage, and it's been running quietly in the background this entire time. Gold is currently trading above $3,000 per ounce. That is not a small number. For most of modern financial history, gold was considered a relic. Warren Buffett famously said it was a useless metal that just sat there. Central banks were selling it. Institutional investors weren't touching it. It was the asset class for paranoid people who kept their savings in a shoebox. Then something changed. Central banks, the big ones, the ones in China, Russia, India, Turkey, Poland, started buying gold at a pace not seen since the early 1970s. In 2023 and 2024 combined, central banks globally purchased over 2,000 tons of gold. That's more than any two-year period in recorded history. Why? Because the weaponization of the US dollar, specifically the decision to freeze Russian foreign exchange reserves after the Ukraine invasion, sent a quiet but earth-shattering message to every central bank that isn't perfectly aligned with Washington. The message was, dollar reserves are not safe if we disagree with your foreign policy. And so the oldest hedge in human history, gold, came roaring back as rational diversification by sovereign governments managing trillions of dollars. When central banks buy gold, institutional investors follow. When institutional investors follow, the ETFs fill up. When ETFs fill up, the price rises. The pattern plays out in slow motion, but it plays out. Gold miners, Barrick, Newmont, Agnico Eagle, have been among the quiet winners of this entire geopolitical cycle, while everyone was focused on artificial intelligence. Alright, now I have to be honest with you, because this script would be incomplete without it. Not every geopolitical trade works. Not every conflict follows the same pattern. And there are real, meaningful risks to positioning around war that the optimistic version of this story glosses over. The risk of escalation is not symmetric. A contained regional conflict and a full-scale exchange involving nuclear-armed states are not the same thing. The latter doesn't produce winners in financial markets. It produces something altogether different. There's also the risk of rapid de-escalation. Ceasefires happen. Diplomatic breakthroughs happen at 3 a.m. on a Tuesday when nobody is watching. And if you're positioned for persistent conflict and the conflict suddenly ends, those trades reverse violently. Oil can also be manipulated in both directions. OPEC decisions, American Strategic Petroleum Reserve releases, demand destruction from a slowing global economy. All of these can cap oil prices even when supply is genuinely threatened. And defense stocks, despite their consistent historical performance, are not immune to budget politics, procurement scandals, or the simple reality that wars end. The point is not that geopolitical investing is a guaranteed formula. The point is that most retail investors respond to geopolitical crisis with pure emotion, panic, paralysis, or both, while a smaller, more informed group responds with frameworks. The framework doesn't guarantee winning. It just stops you from being the person who sells at the bottom and buys back in at the top. Let's zoom all the way out for a moment. What we are living through right now is not a temporary disruption. It is a structural realignment of global power that happens maybe once or twice a century. The post-Cold War era, the 30-year period of American unipolar dominance, globalized supply chains, and relatively stable multilateral institutions, is over. It ended gradually and then all at once. The 2008 financial crisis, the 2016 political disruptions, COVID breaking global supply chains, Ukraine changing the security calculus of every nation in Eurasia, and now a Middle East that refuses to stabilize. In these transition periods, these long, uncomfortable decades when the old order breaks down and the new one hasn't fully formed, capital behaves differently. It doesn't flow freely toward the highest return. It flows toward safety, toward proximity, toward hard assets and national champions. That's why you're seeing reshoring of manufacturing. That's why semiconductor fabs are being built in Arizona. That's why every major economy is subsidizing strategic industries at levels that would have seemed like socialism a decade ago. And that's why the playbook, buy global tech, own bonds, ignore commodities, trust globalization, is being quietly retired by the smartest long-term capital allocators in the world. The question isn't whether this transition will be volatile. It will be. The question is whether you understand the new terrain before you're forced to navigate it. Here's what I keep coming back to. Every pattern in financial history has a shelf life. The geopolitical trade, energy, defense, gold, reshoring has been working. It has logic behind it. It has numbers behind it. It has central bank buying and government spending and supply disruption all confirming the thesis. But the best trades always feel most comfortable right before they stop working. And somewhere in a trading room in Connecticut, that same portfolio manager who smiled when the market opened red is now asking a different question. He's asking, am I about to be early to the exit? Because the real skill in geopolitical investing isn't getting in. Everyone eventually understands the trade. The real skill is knowing when the world has priced in enough fear and what comes next. I don't have that answer. And honestly, neither does he. But the investors who are asking the question, the ones who are thinking one move ahead instead of reacting to yesterday's headline, are already playing a different game than the rest of the market. The question now is whether you're watching that game or playing it. If this breakdown gave you a sharper lens on what's actually happening in these markets, hit subscribe. We go deep on the mechanics that most financial channels won't slow down long enough to explain. If you found this useful, share it with someone who's been watching their portfolio drop and can't figure out why the narrative doesn't add up.